dear students, welcome to the second session on the chapter Valuation of Shares. In the previous session, we have discussed in brief about the various methods of valuation of shares. In total, there are three methods. The first one is net asset method, or it is also called intrinsic value method or asset backing method. The second one is yield method or dividend yield method, or it is also called market value method. And the third one is dual method or fair value method. So there we have just discussed in brief about the theory aspects as well as formula to calculate the value of shares under all those methods. But now from this session onwards, let us take up those methods one by one in detail. Let us once again discuss the theory part as well as solve few problems under each of the three methods. Okay, so let's start the session now. Here, let's begin with the first method, that is intrinsic value method or net asset method or asset backing method. As I said in the previous session, under this method, that is intrinsic value method, the value of share is calculated on the basis of net asset available for the equity shareholders and the number of equity shares. Okay, so here we calculate the number of shares on the presumption that the company is going to be liquidated or company is going to be wound up. Okay, in such a case, when the company goes into liquidation, whatever the assets available in the company, whether it is tangible asset or intangible asset or any other kind of realizable asset, all those realizable assets have to be realized, and whatever the sale proceed they get, that should be used for paying of the outside liabilities first, that is both short term and long term, and then whatever the amount remains, that belongs to the shareholders, both to the preference shareholders and equity shareholders. First, the amount has to be paid to the preference shareholders. After paying the preference shareholders, whatever the amount remains, that belongs to the equity shareholders. It is termed as net assets belonging to the equity shareholders. That is taken as the base to calculate the value of shares. So here, the formula is value of share is equal to net asset available for equity shareholders divided by number of equity shares. So how do we calculate the net asset available? There is a format. So here, you are going to prepare it in a table consisting of two columns. So we are going to write the present values, and here you should remember that when you are writing the various assets, you should write the present market value. Only if the present market value is not available, then you have to write the book value, assuming that the book value itself is the market value. If it is available, always write the present market value. Okay, so you have to write the present market value of various fixed assets, then present market value of various current assets, present market value of non-trading investment, because it is also realizable asset. Though it is the investment made outside the business, if you are going to close your company, you have to realize your investment also. Then present market value of intangible asset like goodwill or copyright or patent right, etc. So when you add all this, okay, present value of various assets, you get the total, and that total is termed as gross market value of all assets. Okay, from this total we are going to deduct the external liabilities, both short term and long term. So when you deduct this external liabilities, whatever the balance you get, that is called net asset available for all types of shareholders. Okay, so when I say all types of shareholders, it includes both the types, preference shareholders and equity shareholders. First, as the preference shareholders have preferential right, the amount belonging to them have to be paid first. Okay, so you are going to write less amount payable to the preference shareholders. It can be the preference share capital, or it can be the arrears of preference dividend for the past few years, or the premium on redemption if it is redeemable at premium. Okay, so all these amount have to be deducted from this net asset available for all types of shareholders. The remaining balance is called net asset available for the equity shareholders. Okay, so here the intrinsic value of a share is equal to net asset available for equity shareholders divided by number of equity shares. So this is the format in which we are going to calculate the intrinsic value of a equity share. So let us take up the first question now. The following is the balance sheet of Sunlight Limited as on 31st/12/2007. On the asset side, land and building, the book value is 75,000, but in the bracket it is given that the present market value is 1,50,000. Then the plant and machinery, book value is 80,000, present market value is 1 lakh. Trademarks book value is 10,000 but the present market value is 8,000. Stock 1 lakh, debtors 54,000, investment 20,000, cash at bank 20,000, preliminary expenses 16,000. On the liability side they have given 20,000 equity shares of rupees 10 each 2 lakh, general reserve, creditors, workmen's savings account and profit and loss account. We find in the next adjustment that find out the intrinsic value of each equity share after taking into account the following facts. The first one, interest payable to creditors is rupees 1,000, bad debts amounted to 2,000, investments are worth only 16,000. Okay, so this is the question given here. So as we just now discussed in the previous slide, we have to first calculate what is the net asset available for the equity shareholders. Initially we are going to write the present market value of all types of assets, okay, which are realizable. Coming to the first one, land and building, you should not consider this book value because the present value is given. So land and building, present value 1,50,000, plant and machinery, present value 1 lakh, trademarks, present value 8,000, stock, regarding stock they have not given any adjustment, so you have to consider book value itself as the present value. Then coming to debtors, actually book value is 54,000 but out of which 2,000 is considered as bad debt, they cannot recover, so you have to deduct it, only 52,000 has to be taken as the present market value. Then investment, book value is 20,000 but the present market value is 16,000, so you have to consider 16,000. Then cash at bank, it is already in the realized form, you have to take as it is. Preliminary expenses is not a realizable asset, don't consider that. So when you write, see, present market value of land and buildings 1,50,000, present market value of plant and machinery 1 lakh, trademarks 8,000, stock 1 lakh, debtors less bad debts, investment at the present value 16,000, cash at bank. So you get total of 4,46,000. So which is called gross market value of all assets. From this we are going to deduct the external liabilities. If you see the liability side, you have to identify here what are the outside liabilities. First they have given equity share capital, no. General reserve, no. Creditors, yes. What is the amount due to them? 50,000, but there is one adjustment. Interest payable to creditors is 1,000, so you have to add that. So total creditors amount payable to creditors will be 51,000. Then workmen's savings account, it is a liability. Please don't get confused with the workmen's compensation fund. So there are two items. One is workmen's compensation fund, which is the accumulated reserve. Okay, so that fund is used for giving the compensation if at all workman meets with any accident. But this is workmen's savings account. Employees have opened savings account with the company and they have deposited their money, and ultimately if the company has to be liquidated, you have to pay back that amount because that amount belongs to the workman or the employee. So this becomes a liability, workmen's savings account. Then profit and loss account, no. So only there are two liabilities, external liabilities. First one is creditors and workmen's savings account. So when you deduct this from the gross market value, you get the balance of 3,45,000. If you see the liability side here, do we have preference share capital here? No, preference shareholders are not there. So whatever the balance you get here is called net asset available for equity shareholders. Okay, now we have to apply the formula. Intrinsic value is equal to net asset available for equity shareholders divided by number of equity shares. 3,45,000 divided by 20,000, which comes to rupees 17.25 per share. So this is first question. Now let us take up the second question. Following is the balance sheet of A Limited as on 31st July 2007. They have given on the asset side cash in hand, cash at bank, debtors, stock, land and building, furniture, goodwill, discount on issue of shares. On the liability side, 3,000 equity shares of rupees 100 each 3 lakh, 1,500 8% preference shares of rupees 100 each 1,50,000. Then general reserve, profit and loss account, bank loan, creditors. The value of asset revealed as follows: furniture to be depreciated by 10%. The value of stock, land and building and goodwill are estimated at 1,20,000, 2,50,000 and 80,000 respectively. Debtors are expected to realize 80% of the book value. Find out the value of A Limited's equity shares. So here again we have to follow intrinsic value method. So first we will be calculating in the first step what is the net asset available for the equity shareholders? For that we have to write the present market value of various kinds of assets. So now coming to the cash in hand and cash at bank, it is already in the cash form, so you have to write as it is. Then coming to datas, they have not given any adjustment here. Here they have given third one, datas are to be expected to realize 80% of the book value. So here the total book value is 80,000, but out of which only 80% will be realized, remaining 20% is bad debt. So you have to calculate 80% of 80,000. So cash in hand here 2,000, cash at bank 20,000, present value of data 80,000 into 80%, 64,000. Then stock, they have given stock is realizing 1,20,000. Then land and building is realizing 2,50,000. Then furniture is realizing, they have not given here, furniture to be depreciated by 10%. So the book value is 30,000. From that we have to deduct 10% towards depreciation. So 10% on 30,000 comes to 3,000. You deduct 3,000 from 30,000, we get the balance of 27,000. So that will be the present market value. Then the goodwill, they have given the present value to be 80,000. Okay, so these are, and one more asset they have given, discount on issue of shares. So it is a fictitious asset, not a realizable asset. Don't consider this one. Okay, so when you get the total, it is 5,63,000, which is called gross market value of all assets. From this we are going to deduct the external liabilities. First is equity share capital, no. Preference share capital, no. Then general reserve, no. Profit and loss account, no. Bank loan and creditors, only two liabilities are there, bank loan and creditors. You take the total to the outer column. So you will have a balance of 4,98,000. So this is called net asset available for all types of shareholders, 4,98,000. Here if you see the liability side, there are preference shareholders, and what is their capital? 1,50,000, 1,500 preference shares of rupees 100 each. So they have to be given their capital of 1,50,000. Then have they given any arrears of preference dividend or premium on redemption? No. So only the amount belonging to the preference shareholders, amount payable to the preference shareholders is their preference share capital, 1,50,000. You are deducting from 4,98,000. You will have balance of 3,48,000, which is called net asset available for the equity shareholders. Then the next step would be for calculating the intrinsic value, net asset available for equity shareholders divided by number of equity shares, 3,48,000, which you calculated here, divided by number of equity shares. How many shares are here? 3,000. Okay, you have to divide it by 3,000. You will have rupees 116 per share. Okay, so this is the solution for the second question. Then let us take up one more question, third one. From the following, find out the value of share. Under the fixed asset, they have given goodwill, then investment, current assets and loans, current assets, loans and advances. Under that current assets 50,000, loans and advances 30,000, miscellaneous expenditure 10,000. Then coming to the liability side, share capital 20,000, equity shares of rupees 10 each, 2 lakh, reserves and surplus, profit and loss account, unsecured loan, current liabilities. For the purpose of valuation of share, goodwill shall be taken at 2 years purchase of average profit of the last 5 years. Profit for last 5 years they have given 60,000, 70,000, 40,000, 50,000 and 50,000. Okay, so this is the question given here. Now coming to the first step calculation, that is net asset available for equity shareholders. Under the fixed asset, they have given the book value of goodwill to be 1,90,000, but it is given that we have to value the goodwill on the basis of 2 years purchase of the average profit of the last 5 years. Okay, and that is going to be the present market value. So here what is the formula we use for value of for calculating the value of goodwill under purchase of average profit method? So value of goodwill is equal to average profit into number of years of purchase, here 2 years purchase. So what you have to do, first you have to add the profit of 5 years divided by 5, average profit, total profit divided by 5, you get average profit of 54,000, multiply with the number of years of purchase, that is 2, you will have the value of goodwill at 1,08,000. So that is the first asset. Then coming to investment, they have not given, so you are considering that book value itself is the market value, which is 3 lakh. Then under the current assets and loans and advances, they have given current asset, you have to consider same value, that is 50,000, and loans and advances, you may get confusion like why loans and advances are given on the asset side. It is not a liability. The company has advanced loan to the employees, okay, so it becomes the asset. So loans and advances we have 30,000. If at all company goes into liquidation, they will recover this loans and advances from the employees, okay. Then miscellaneous expenditure is a not realizable, it is not a realizable asset, it is a fictitious asset. So these are the assets you have to write: present value of goodwill which you calculated in the working note, investment, current assets and loans and advances. The total of this comes to 4,88,000, which is called gross market value of all assets. Then coming to the liabilities, first they have given share capital, no; reserves and surplus, no; profit and loss account, no; unsecured loan, yes, it is a liability; current liabilities, yes, okay. So this liability you are going to deduct. So you will have balance of 3,88,000. Then if you check the liability side here, they have not given us preference share capital here. So which means that only equity shares are there. So whatever the balance you get, 3,88,000. So everything belongs to the equity shareholders. So you have to write net asset available for equity shareholders. Then the formula would be intrinsic value is equal to net asset available for equity shareholders divided by number of equity shares. 3,88,000 divided by what is the number of equity shares you find here? 20,000. You have to divide it by 20,000. So it is rupees 19.4 per share. Okay, it is for one share. So this is how we calculate the intrinsic value under first method, that is intrinsic value method or net asset method or asset backing method. So let us take a few more questions in the upcoming videos. Thank you for watching.